Today, we are cutting straight through all the noise. We're focusing on one massive story, Apple. We've got our hands on this incredibly aggressive, highly bullish analysis report. It's titled Apple Stock Analysis. The Road to $4 trillion starts NowW. And if you've been tracking the markets, you know just how big this is. Apple is closing out 2025, trading at around, $273 a share. It's officially cemented a market cap over $4 trillion.
It's a number that's almost hard to comprehend.
Yeah.
It's bigger than the GDP of nearly every country on the planet.
It's staggering. But here's the thing, the core idea in this report, the provocative part, is that hitting $4 trillion wasn't the finish line.
No.
It was the starting gun.
That's it. That is the key shift in thinking we really need to nail down today. We are looking forward, resolutely forward, not back at the milestone. Our mission here is to understand the precise drivers behind this prediction. We need to dissect the financial fundamentals, of course, but also the near-term technical signals the analysis says are about to propel this thing even higher.
Okay, let's unpack this then. After a run like that, hitting $4 trillion, why is this analysis saying the real growth phase starts now? We've heard supercycle before with iPhones. What's so different this time? What are the catalysts?
The report is, it's unequivocal on this. It all comes down to artificial intelligence.
AI.
But specifically Apple's unique approach to it. The argument is that this is the primary catalyst because it fundamentally changes what Apple is. It's not just a premium hardware company anymore. The perception is shifting. It's becoming the, and I'm quoting here, premier gateway to mainstream AI.
But wait, why is this AI wave really any different? People are already using AI apps on their current iPhones. What makes Apple Intelligence such a trigger that it would force millions of people to upgrade perfectly good phones?
That's a crucial point, and the analysis hits it head on. The difference is the deep integration. We're not talking about some app you download. We're talking about features baked right into the operating system, into Siri, into your mail, everywhere. And the analysis points to the full rollout of these features in late 2025 as the specific trigger, because this whole experience depends on the neural engine in the newest chips. Older phones they won't be able to run it properly.
So the argument is that Apple has basically created a necessary reason to upgrade, not just an optional one.
Exactly. It forces a hardware replacement cycle.
Yeah.
But even with that, you need the financial stability to back up the valuation. And that's where the report points to the massive moat from services revenue.
That feels like the company's insurance policy.
It absolutely is. You look at iCloud, Apple Pay, music, the App Store, all of that is hitting all-time highs. It makes the ecosystem stickier than ever.
It's that recurring high-margin revenue.
Right. It stabilizes everything no matter what happens with iPhone sales quarter to quarter.
And the September quarter numbers, they were record-breaking. It just confirmed the strength of both sides of the business.
They were stunning. $102.5 billion in revenue. But the number that really matters, the one that validates the premium price tag, is profitability. Their gross margins are sitting at a very, very healthy 47%.
47%. For you listening, what does a 47% gross margin actually mean for a company this huge?
It signifies unparalleled power and efficiency. It means for every single dollar Apple brings in, 47 cents is left over after the cost of making the product. That level of profitability gives them incredible financial leverage. They can reinvest in R&D, they can make acquisitions, all while their competitors are just trying to cut costs.
And that resilience leads us straight to their balance sheet. The amount of cash they have is it gives them options most companies can only dream about.
This cash position is paramount to the entire bullish case in the analysis. Just look at last quarter. They generated roughly $26.5 billion in free cash flow.
And we should probably define that for clarity. What's free cash flow?
It's arguably the purest measure of a company's financial health. It's the cash left over after paying for everything, all operations, all capital expenditures. It's pure discretionary money.
And generating $26 billion of that in one quarter.
It gives them a phenomenal competitive advantage. And on top of that, they're holding over $30 billion in just liquid cash.
So what does that cash allow them to do? That's the key, right?
It's what the report calls their strategic firepower. It lets them do massive ongoing stock buybacks, which boosts earnings per share. It lets them raise dividends. And critically, it lets them acquire any emerging tech they need to stay ahead, especially with AI rivals popping up, all without taking on a dime of debt.
Which brings us right to the big valuation question, the elephant in the room. The stock trades at a huge premium. The PE ratio is around 36. That's the point where the bears start sharpening their claws and yelling bubble.
And it's a fair question to ask. 36 times earnings is not cheap. It means investors are willing to pay $36 for every $1 of profit the company makes. So while the bears are quick to label it expensive, the bullish counter-argument is fierce.
And what's the core of that counter-argument?
It's that you're paying a premium for quality and for projected dominance. The analysis argues that investors see this as the best company on Earth. The valuation is pricing in the massive growth they expect from this AI supercycle, which they think will accelerate earnings much faster than the current PE ratio suggests.
But isn't paying a huge premium for the best company on Earth sometimes a classic signal of a market top? Does the analysis dismiss the risk that maybe AI adoption is slower than they think?
It acknowledges the risk, absolutely, but it pivots right back to that financial stability we just talked about. The argument is the company is so fundamentally sound with that free cash flow and the services moat that even if the supercycle takes a bit longer, the downside risk is limited. The floor for Apple is just much, much higher than for anyone else.
Okay, here's where it gets really interesting. We're shifting from the fundamentals to the pure technical price action. The analysis breaks down what the stock chart is telling us right now.
And the technicals are showing enormous conviction from institutional players. From the big money, let's look at the action right around that $273 level. The report details a recent event they call a consolidation day.
What does a consolidation day actually mean for the stock?
It's a day where the stock trades kind of flat or maybe slightly down after a big run-up. The market is just pausing to, digest the gains. Well, during one of these recently, the stock dipped for a moment to 272.28. And the key thing the analysis points out is what happened next.
Buyers stepped in.
Immediately and fiercely. Large buyers, which signals institutional funds.
And that immediate buying, that tells you something very specific.
It does. It signals that institutions see 272 as a critical floor. It's proof of organized support, with big orders waiting right there to scoop up shares. It shows real conviction.
So we have this strong institutional floor just under 273. And right now, the stock is knocking on the door of resistance at 274. What's the technical forecast if it breaks that level?
Breaking 274 is expected to clear out the short-term sellers. And that opens a direct path to the 52-week high of $288. Once those resistance points are gone, momentum often just takes over.
And for you, the listener, the analysis provides a very specific, actionable idea based on all this.
Yes, this is the application. The report sees any pullback to the 270 level, so just below that support floor, as a golden opportunity to accumulate shares. It's advising not to chase the stock, but to wait for a brief dip.
And the timing on this is critical.
Exactly. This is all framed specifically before the Q1 earnings run-up, which we expect in late January. Investors anticipate those huge holiday quarter numbers, and the stock often runs up in the weeks before the announcement.
And the ultimate near-term target, just past that 4 trillion milestone, is that big round number, $300 a share.
It is absolutely a magnet. Once you get past 288, the market just loves a round number like 300. It becomes a kind of self-fulfilling prophecy.
It's a huge psychological victory.
A major one. Hitting 300 would confirm that the market fully believes the AI supercycle is real and that the growth story is locked in.
So what does this all mean? With this AI wave driving necessary upgrades and a holiday quarter that's expected to be a record breaker, well, the analysis concludes that betting against Apple right now feels like betting against the future. The advice is unambiguous. Stay long, stay bullish.
And if we tie it all back to the beginning, that $4 trillion valuation isn't a celebration of the past. It is entirely about the market's faith that Apple intelligence will drive the future and justify that premium PE ratio.
Which brings us to our final provocative thought for you to mull over. The analysis frames that massive $30 billion cash reserve mainly as a tool for stock buybacks and dividends. But if the company were to shift its focus, if it wanted to aim for the next massive leap 5, maybe $6 trillion, what kind of audacious new technology acquisition, something totally outside of AI and services, would be necessary to blast past $300 and truly forge the path to that next unprecedented milestone? That's the question of the future.